Hey everyone, welcome back to Corporate Decoder, the place where we uncover the hidden stories in financial filings. And let me tell you, Marin Software is facing a bit of a rough patch in its latest report. It seems like they've been on a bit of a roller coaster, and we're going to break down exactly what's happening. Before we dive in and uncover all the juicy details, make sure you hit that subscribe button and ring the notification bell so you don't miss our next deep dive. Also, we have a fantastic Discord community where we discuss these filings in real time and share insights you won't want to miss. Link is in the description below. Alright, let's get straight into it. We're looking at a Form 8K filing from Marin Software Incorporated. Now, these forms are usually for big, unexpected events, and this one certainly doesn't disappoint. The date here is July 29, 2025, and it's reporting on very significant happenings. First off, it seems like Marin Software has been delisted from the Nasdaq capital market. On June 17th, they received a notice from Nasdaq stating they weren't meeting certain listing requirements and didn't provide a solid plan to get back on track. By June 26th, their stock was suspended from trading. This is a pretty big deal for a publicly traded company. Being delisted means your stock is no longer traded on a major exchange, which can significantly reduce its liquidity and make it much harder for investors to buy or sell shares. The company's main product here is their common stock, trading under the symbol MIN. Now, after being delisted from Nasdaq, the deregistration process starts, which can take about 90 days after Nasdaq files a form with the SEC. This essentially means they're moving away from the traditional stock market. The really juicy part of this filing is that Marin Software has filed for Chapter 11 bankruptcy protection. This happened on July 1st, 2025. Chapter 11 bankruptcy means the company is trying to reorganize and restructure its debts while still operating. It's not a liquidation, but it signals that they're in a lot of financial trouble and need court protection to figure out a way forward. As part of this bankruptcy process, they've entered into a significant financing agreement. On July 29th, the bankruptcy court approved what's called a final DP order. DIP stands for debtor in possession, and this order allows them to get new financing to keep the lights on during the bankruptcy proceedings. They're getting up to $1,000 from Wirewares LLC, which they're calling 5Y. A portion of this was already made available in early July. This is the lifeline that allows them to continue operations, pay employees, and manage their affairs while they go through the restructuring. Moving forward, the company is working on a plan of reorganization. The bankruptcy court has given conditional approval to the disclosure statement, which is a document that explains the proposed plan to creditors and shareholders. A hearing to get final approval and actually confirm the plan is set for August 28th. This plan is crucial because it lays out how creditors will be paid and how the company will operate moving forward. Any objections to this plan need to be filed pretty soon by August 28th. This plan is crucial because it lays out how creditors will be paid and how the company will operate moving forward. Any objections to this plan need to be filed pretty soon by August 21st. The details of this first amended plan of reorganization are pretty stark for existing shareholders. It states that all outstanding shares of common stock, including those tied to stock options and restricted stock units, will be cancelled and discharged. Existing shareholders won't receive anything directly from the plan except for any leftover cash after all the company's debts are paid. Interestingly, the plan sponsor, Accession Holdings Inc., will be issued up to 1,000 shares of new common stock in the reorganized company. This is after accounting for any of the debt from the DIP financing that 5Y decides to convert into stock. The plan aims to pay all creditors in full and then distribute any unused DIP financing to the current equity holders. But as we just saw, getting any cash out of this situation is unlikely for common shareholders, unless there's a significant amount left over after all debts are settled. The company is very clear that trading in their common stock during this bankruptcy is highly speculative and comes with substantial risks. They explicitly state that the trading prices might not reflect the actual recovery, if any, for shareholders. So if you're thinking about buying or holding Marin Software stock right now, they're urging extreme caution. Looking at the exhibits, the main one is the first amended combined disclosure statement and plan of reorganization. This is the document that really lays out the nitty-gritty of how the company plans to get out of bankruptcy and what happens to everyone involved. The other exhibit is the standard cover page interactive data file. Finally, we see the signatures. Robert Burtz, the Chief Financial Officer, signed off on this report on August 4th, 2025. This signature confirms that the company is officially reporting this information. Now, let's put on our investor hats. and see what this all means for Marin Software. The company's delisting from Nasdaq and subsequent bankruptcy filing paint a pretty grim picture for existing shareholders. The plan to cancel all existing common stock essentially wipes out the equity of current investors. While the possibility of receiving remaining cash exists, it's a very distant and uncertain prospect, especially given the complexities of bankruptcy proceedings. The debt financing from YVI via the LLC is a critical step for the company's survival during the Chapter 11 case. It provides the necessary liquidity to continue operations and work towards a reorganization plan. Caxa Holdings Inc. coming in as a plan sponsor suggests there's an external party willing to invest in the company's future, which is a positive sign, but their stake is very small in terms of shares. The core problem for Marin Software appears to be a failure to meet Nasdaq's continued listing requirements, which likely stems from deeper financial issues that led them to bankruptcy. Being unable to secure adequate financing or demonstrate a path to profitability in the past likely contributed to this downfall. For investors, the message is clear. The common stock as it exists today is on its way out. Any investment now is a gamble on the extremely slim chance that there will be significant residual assets after all debts are settled and the reorganized company is successfully established. The key risks are the uncertainty of the bankruptcy process itself, the potential for unforeseen liabilities, and the ability of the company to emerge as a viable entity post-res judilf. The potential for unforeseen liabilities and the ability of the company to emerge as a viable entity post-restoration. In conclusion, Marin Software is in a severe financial downturn. The bankruptcy filing and the plan's impact on existing shareholders are significant indicators of the company's distress. While the DIP financing provides a short-term lifeline, the long-term outlook for common stockholders is exceptionally bleak. Alright, that's our breakdown of Marin Software's latest filing. What's your take on these numbers and what they signal for the company's future? Do you think there's any hope for existing shareholders? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out, and subscribe for more no-nonsense deconstructions of corporate filings. And don't forget to join our Discord community, linked in the description. For more in-depth discussions, thanks for watching. See you next time.